Imagine waking up tomorrow to discover that one of the most valuable companies in the world has stopped buying AI chips. Not because AI failed, not because people stopped using ChatGPT or image generators, but because the math stopped making sense. That single decision would send shockwaves through Silicon Valley. Chip manufacturers would stumble, data center projects would freeze, investors would suddenly ask questions they should have asked years ago. And that's the strange part. Almost nobody is asking those questions now. Because while everyone is busy talking about the AI revolution, there's another story unfolding underneath it. A story about billions of dollars, impossible expectations, and an economic engine that only works if everyone keeps believing the next breakthrough is just around the corner. This isn't a story about AI replacing humans. It's a story about whether the business of AI can actually pay for itself. History has a habit of repeating itself, just never in exactly the same way. In the late 1990s, investors poured money into internet companies. The logic sounded obvious. The internet would change everything. It did, but that didn't stop the dot-com bubble from collapsing. The technology was real. The timing and expectations were wildly disconnected from reality. Today, AI feels eerily familiar, except this time the numbers are much, much bigger. Every week brings another headline, another company announcing an AI strategy, another billion-dollar investment, another CEO declaring that artificial intelligence will redefine the future. And maybe they're right. But beneath all the excitement sits one uncomfortable question. Who is actually making enough money to justify what everyone is spending? Because building modern AI isn't like building a normal software company. Software used to be beautiful, because once you wrote the code, copying it was almost free. One customer or 100 million customers, the economics barely changed. AI flips that logic upside down. Every conversation with an AI model requires enormous computing power. Every generated image, every summarized document, every line of code. A data center somewhere is consuming electricity, cooling thousands of specialized processors, and burning through hardware that costs tens of thousands of dollars per chip. It's less like selling software. It's more like operating thousands of tiny factories that never stop running. Now multiply that by hundreds of millions of users. Suddenly, the cost structure starts looking very different. That's why the companies leading the AI race are spending at levels that would have sounded absurd just a few years ago. Not millions, not billions, hundreds of billions. Entire campuses of data centers, power plants dedicated to feeding them. Global supply chains centered around one crucial piece of hardware, the GPU. Originally designed for gaming, now arguably the most valuable industrial machine on Earth. One company became the symbol of this transformation, NVIDIA. For years, it sold graphics cards mostly to gamers and researchers. Today, its chips are effectively the picks and shovels of the AI gold rush. When everyone rushes to mine for gold, the safest business is often selling the shovels. That's why NVIDIA's growth has been extraordinary. Its customers aren't buying chips because they need them today. They're buying because they believe they'll need even more tomorrow. That distinction matters because demand driven by expectations behaves very differently from demand driven by profits. Think about building a restaurant. You buy more tables because customers keep coming. Now imagine buying 10 more restaurants before the first one makes money. That's much closer to what's happening across AI infrastructure. Companies aren't simply expanding successful businesses, they're racing to avoid falling behind. Nobody wants to be the company that missed the AI revolution. And fear is a surprisingly powerful investment strategy, until it isn't. Here's where the math becomes uncomfortable. Training a frontier AI model can cost hundreds of millions of dollars. Some estimates suggest the next generation could require several billion. Then comes deployment. Running the model, maintaining it, updating it, protecting it from abuse, paying for electricity, replacing aging hardware. The bill never really stops.
So naturally, you'd expect enormous revenue. Sometimes that's true. Enterprise customers are paying significant amounts for AI tools. Developers are integrating AI into software. Businesses are automating repetitive tasks. Real value is being created. But here's the catch. Revenue is growing. Costs are also exploding. Imagine opening a lemonade stand where every cup costs 90 cents to make and customers only want to pay $1. Technically, you're profitable. Barely. Now imagine spending $10 billion building the stand. Suddenly, the economics don't look so exciting. The AI industry isn't facing a demand problem, it's facing a margin problem. The technology keeps improving, but the cost of staying competitive remains astonishingly high. This creates an interesting chain reaction. Cloud providers buy more chips, chip manufacturers increase production, construction companies build more data centers, utilities expand electrical grids, real estate developers buy land, entire local economies begin reorganizing around AI infrastructure. It's an investment boom, but investment booms have a strange psychological effect. They begin assuming their permanence. During the railway boom, people believed every town needed rail connections. During the telecom boom, companies buried far more fiber optic cable than anyone could immediately use. Ironically, that excess fiber later became incredibly useful, just much later than investors expected. AI may follow a similar path. We could absolutely be building infrastructure that society eventually needs. The question is whether today's valuations assume tomorrow arrives much sooner than reality allows. There's another layer almost nobody discusses: the customers. Most people love using AI, especially when it's free or nearly free. But free users don't pay data center bills. Subscriptions help. Enterprise contracts help even more. Still, companies are chasing something much larger. A future where AI becomes as essential as electricity or the internet. If that happens, today's spending may look brilliant. If adoption slows even slightly, those same investments become much harder to justify. And markets don't like uncertainty. They especially don't like expensive uncertainty. There's also a quiet irony here. The biggest winners so far aren't necessarily the companies with the smartest AI. They're often the companies selling the infrastructure. It's like a gold rush where shovel makers became richer than many miners. That doesn't mean the miners eventually fail. It simply means infrastructure profits often arrive earlier. Applications take longer. Think back to electricity. Electricity transformed civilization, factories, homes, transportation, entertainment. But many early investors lost fortunes because they overestimated how quickly those transformations would become profitable. The technology changed everything. The market still punished unrealistic expectations. That's an important distinction. A bubble doesn't require fake technology. It requires real technology paired with impossible assumptions. And that's what makes today's AI conversation so complicated. The hype isn't entirely wrong. AI really is changing medicine, programming, finance, education, logistics, and scientific research. Companies genuinely are becoming more productive. Researchers genuinely are solving problems that once seemed impossible. None of that guarantees current prices make sense. Those are completely different questions. Imagine buying shares in an airline immediately after airplanes were invented. You'd be right about aviation. You could still lose money. Being correct about the future isn't always enough. Timing matters, valuation matters, economics matter. Today, investors often speak about AI as though its success is inevitable. Maybe it is, but inevitability says nothing about who wins or who loses. Remember MySpace, BlackBerry, Yahoo. Entire industries can be right while individual leaders disappear. The same could happen with AI. Some companies spending billions today may dominate the next decade. Others may become expensive footnotes. Nobody knows which is which, and that's precisely the risk. Markets crave certainty. Reality rarely provides it. So is there an AI bubble? Maybe, maybe not. That depends on what you mean by bubble. If you mean the technology is fake, the answer is almost certainly no. AI is already reshaping the economy. If you mean investors have become too optimistic about how quickly profits will catch up with spending, that's a much harder question, because underneath every breakthrough headline sits an invisible equation. How much does it cost, how much does it earn, and how long can you keep spending more than you make while promising that the future will eventually balance the books? For now, capital markets seem willing to keep writing checks. Governments are encouraging investment, companies are racing forward, consumers keep clicking, the machine keeps accelerating. But every investment boom eventually reaches the same moment, not when people stop believing in the technology, but when they start demanding profits.
That's the moment optimism meets arithmetic, and arithmetic has a reputation for being far less forgiving than hype. So the next time you hear that AI is changing the world, assume that's true. Then ask a different question. Who is actually making money from changing it? Because the answer to that question may determine whether we're witnessing the beginning of the greatest technological expansion in decades or the most expensive lesson in modern finance.